So here is the accounting equation. The accounting equation is assets equals liabilities plus equity. So basically, the assets pertain to what the company owns, and the liabilities and equity pertains to the what the company owes. So basically, the accounting equation is always and should be always balanced. All right. So when you have $5 assets, you then have a total $5 of liabilities and equity. All right. So now let's understand how the accounting equation really works. All right. So what are assets? So as you know, assets are resources controlled by the entity and which may be either cash, receivables, inventory, fixed assets, investments, and many more. All right. So how about liabilities? Liabilities are obligations of the company, and these are the liabilities that are owed to external parties. So basically, liabilities include accounts payable, loans payable, notes payable, mortgage payable, accruals, and many more. All right. So equity is the residual interest in the net assets of the corporation or a business after deducting all of its liabilities. All right. Basically, for a corporation, it is called stockholders' equity. And for sole proprietorship, it is called owner's equity. And for a partnership, it is called partner's equity. And then for the accumulated profits, it is called retained earnings. So basically, this accounting equation works like it is always balanced. All right, let's have an example so that we can really understand how the accounting equation works. Sample 1. A company borrowed $10 from a bank. All right, so what are the affected elements of financial position? So by the way, the elements of financial position is the assets, liabilities, and equity. All right, remember that, guys. That is very helpful when you have your board exam, okay? So basically, when you borrow a $10 from bank, the accounts that are affected are cash and then loans payable. So as you can see, you have a $10 total assets now, and then there's a $10 liabilities now. So as you can see, the assets of $10 and the liabilities of $10 is equal. And then the accounting equation now is balanced. Very easy, right? Do you have questions? Questions? All right, perfect. Let's take a look at another example. So the owner invested a computer worth $15. All right, what are the affected accounts? So basically, what did the owner buy or what did the owner invested? A computer. All right, so let's now identify whether the computer is an asset, liabilities, or an equity. So a computer is an asset. So we will indicate here the $15 asset. And then since it is the owner, not coming from a third party, but from the owner of the business, so we will indicate here $15 to the owner's equity. So as you can see, the accounting equation is again balanced. All right, very simple, right? All right, let's now go to the another example and the final one. So the next example is the company purchased on credit an inventory amounting to $5 from its suppliers. Okay, So now we will identify again the affected elements of financial position. So as you can see, what did the company purchase? An inventory. All right. So the affected account is inventory, which is an asset. Here, $5 asset. And then, of course, since it is the company that purchased, it is a liability since it is purchased on credit. And here is the liability, which is accounts payable amounting to $5. All right. So then the accounting equation is again balance. Any question, guys? All right. So as you can see, the accounting equation is very easy and very, very, very understandable. So now, the next topic is all about how to understand the accounts and the debit and credit. So on the next topic, we will discuss how the journal entries work. All right. So if you are new to this channel, just hit subscribe and see you guys on the next session. Thank you.